Welcome to XRP Pro Ledger, and if you hold XRP right now, you need to lock in for the next several minutes because the data that just dropped is the kind of convergence that serious investors spend years waiting for, and most of the market is still sleeping on what it actually means. XRP has officially flipped Binance Coin to reclaim its position as the third largest cryptocurrency on the planet, with an $87.50 billion market cap, $3.94 billion in 24-hour trading volume, and a price that briefly cracked $1.50 this week on a nearly 10% gain that outperformed Bitcoin, Ethereum, and Solana simultaneously. Cumulative spot XRP ETF inflows have now reached between $1.27 and $1.44 billion, with $55 million flowing in from institutions in a single week alone. The SEC versus Ripple lawsuit is fully resolved. The SEC and CFTC have officially classified XRP as a digital commodity, permanently eliminating the security classification risk that suppressed this asset for years. So stay tuned until the very end of this video, because I am going to expose the 2028 quantum secret that is going to make every other blockchain architecture institutionally obsolete, and timeline is closer than anyone in the retail market currently understands. Let us start with the BNB flip, because reclaiming the number 3 spot with $87.50 billion in market cap is not a technical chart event. It is a structural market statement about which assets the institutional capital flowing into this space has decided to trust with a top 3 allocation. Binance Coin held the third position for years, with every structural advantage supporting it: the largest centralized exchange ecosystem on the planet, aggressive token burn mechanics, launchpad access, trading fee discounts, and billions in locked liquidity, all designed to defend that ranking. XRP displaced all of it with $3.94 billion in genuine daily volume, driven by regulatory clarity, institutional ETF inflows, real-world utility deployment across American Airlines, Rakuten Japan, and Mastercard, and a legal status that no other top 5 asset can currently match. The market cap ranking is not a vanity metric. In institutional finance, ranking determines which assets appear on approved product lists, which assets qualify for index inclusion, and which assets institutional compliance teams greenlight for portfolio allocation. The number 3 ranking just opened doors for XRP that the number 4 ranking kept closed. The SEC and CFTC's official classification of XRP as a digital commodity is the legal event that every institution that was waiting on regulatory clarity before making a full allocation has been watching for. And its resolution creates a specific and immediate effect on the institutional demand pipeline that most retail investors are not tracking closely enough. When an asset is classified as a security, institutional allocators face a much higher compliance burden. Securities require broker-dealer registration, investment advisor disclosures, and specific client suitability assessments that create friction in the allocation process. When an asset is classified as a digital commodity, it enters the same regulatory category as gold, oil, and Bitcoin assets that institutional allocators can hold in standard fund structures without the additional compliance overhead of securities regulation. The SEC and CFTC classification is not just the end of a legal battle. It is the regulatory passport that allows every institutional allocator who was waiting for that passport to begin their full allocation process immediately. And the $55 million single-week ETF inflow you are seeing right now is the leading edge of that allocation wave, not its peak. Now, I need you to pay very close attention to the next piece of this story, because what I am about to tell you about the institutional adoption picture is the data that the mainstream crypto media is covering with one-line headlines when it deserves a full analytical breakdown. American Airlines is integrating Ripple Treasury solutions into its financial operations. Think about what that means. American Airlines is one of the largest corporations in the United States, managing billions of dollars in treasury operations across dozens of currencies and dozens of international markets. Their decision to integrate Ripple Treasury solutions is not a marketing partnership. It is a treasury management decision made by CFO-level executives who evaluated every available option for cross-border liquidity management and concluded that Ripple's XRP-based infrastructure was the superior solution. Rakuten Japan enabling XRP payments for 5 million merchants is the same signal from the consumer commerce direction, one of Japan's largest e-commerce ecosystems, making XRP a native payment option for its entire merchant network simultaneously. These are not pilot programs. They are operational deployments at commercial scale, and they represent organic demand that compounds with every transaction. The RLUSD stablecoin's massive rollout combined with the Mastercard pilot program represents the institutional adoption story entering a phase that the XRP community has been building toward for years, and the combination of those two developments in the same window as the BNB flip and the $1.44 billion in ETF inflows is the convergence that serious analysts flag as a regime change rather than a bull market cycle. RLUSD giving institutions a dollar-denominated asset that operates natively on the XRP ledger eliminates the need to exit the XRP ecosystem into traditional banking rails. For the dollar leg of international transfers, it makes XRPL a complete self-contained settlement environment for institutional cross-border transactions. Mastercard piloting within that environment brings the world's second largest payment network into the XRPL ecosystem with the full weight of its merchant relationships and its regulatory infrastructure. Stay tuned because later in this video, I am going to explain exactly how the Mastercard pilot connects to the quantum-resistant upgrade timeline in a way that reveals the full scope of what Ripple is building and why the 2028 deadline is not arbitrary. The To XRP live deployment on Solana through Hex Trust and Layer 0 is a development that needs to be understood for what it structurally adds to the XRP demand picture rather than just celebrated as a technology milestone. Solana hosts one of the most active decentralized finance ecosystems in the entire blockchain space, with hundreds of protocols generating billions in daily on-chain volume. Every single one of those protocols can now include wXRP as a native asset, as collateral in lending markets, as a trading pair on decentralized exchanges, as a yield-generating asset in liquidity pools. This is XRP's utility expanding into a market that it had zero exposure to before this deployment went live. The demand that flows into XRP from the Solana DeFi ecosystem is entirely additive. It does not replace any existing demand. It layers on top of the institutional ETF demand, the cross-border payment utility demand, the RLUSD settlement demand, and the merchant payment demand that is being generated by the Rakuten and American Airlines deployments simultaneously. Every new source of demand that gets added to XRP's demand profile at current prices makes the current price level look more like accumulation and less like fair value. Now let us talk about the 2028 quantum secret, because this is the development that the institutions making 10-year infrastructure commitments are evaluating with the same rigor that they apply to balance sheet analysis and regulatory compliance. And it is the development that most retail investors are treating as a distant future concern, while the smart money is treating it as an 18 to 24-month operational risk that needs to be solved now. Ripple has announced a 4-phase roadmap to make the XRP ledger fully quantum resistant by 2028, and Phase 2 is actively underway right now, testing NIST-approved post-quantum cryptographic algorithms on the live network. NIST is the National Institute of Standards and Technology, the U.S. federal body responsible for establishing cryptographic standards for government and institutional use. The fact that Ripple is implementing NIST-approved algorithms specifically means that the quantum-resistant XRP ledger will meet the cryptographic standards that U.S. government agencies, regulated financial institutions, and defense contractors are required to use. That is not a feature for retail investors. That is a compliance requirement for the institutional clients that Ripple is building this infrastructure to serve at scale. Bitcoin has no quantum resistance roadmap with a specific implementation timeline. Ethereum's quantum resistance plans are vague and underfunded relative to the scale of the problem. Ripple is the only major blockchain infrastructure company that has a 4-phase NIST algorithm-based 2028 targeted quantum resistance roadmap that is actively in Phase 2 implementation right now. For an institution that is building a 10-year digital asset infrastructure strategy, the kind of institution that is deploying the $55 million weekly ETF inflows and the $1.44 billion Cumulative ETF AUM, the quantum resistance question is not optional. It is a foundational requirement for any infrastructure that is expected to be operational in 2030, 2032, and beyond. The institutions building those infrastructure strategies right now are not choosing between a quantum-resistant XRPL and a quantum-resistant Bitcoin. They are choosing between a quantum-resistant XRPL and a Bitcoin with an uncertain quantum resistance timeline. That comparison has one winner, and the $1.44 billion in cumulative ETF inflows is the market's way of telling you which asset the institutional infrastructure builders are choosing. The Clarity Act update from Brad Garlinghouse expecting Senate markup progress by the end of May needs to be contextualized correctly because the retail market is treating the delay as a negative, while the on-chain data is telling a completely different story about how the institutional money is interpreting the same information. A markup delay to the end of May is a legislative calendar event, not a change to the fundamental thesis that is driving the $1.44 billion in ETF inflows, the American Airlines integration, the Rakuten deployment, the Mastercard pilot, or the wXRP Solana launch. None of those developments depend on the Clarity Act passing. They are happening independently of the legislative timeline because XRP already has the regulatory clarity it needs from the SEC and CFTC commodity classification that just resolved the lawsuit. The Clarity Act passing will be an additional catalyst that unlocks the category of institutional capital that requires legislative rather than judicial clarity before allocating. That is incremental demand on top of the demand that is already flowing. A May timeline for markup progress means the catalyst arrives in weeks, not months, and the institutions accumulating at $1.42 to $1.45 right now are positioned for exactly that catalyst. The short-term price projection range of $1.60 to $1.75 from institutional analysts needs to be understood in the context of the full catalyst stack that is operating simultaneously, because those projections were calibrated against the data that existed before this week's developments added the BNB flip confirmation, the $1.44 billion ETF AUM milestone, the American Airlines integration announcement, and the Mastercard pilot program to an already strong fundamental picture. Technical analysis of the current price structure at $1.42 to $1.45 shows a market consolidating after a nearly 10% weekly gain that briefly cracked $1.50, the kind of consolidation that follows a genuine breakout move driven by fundamental catalysts rather than speculative retail enthusiasm. The $1.40 support level is holding as a fortress with institutional volume supporting every test of that level. The $1.60 to $1.75 near-term projections represent the next technical resistance zone above the current consolidation, and given the fundamental catalyst stack operating beneath the current price, those levels represent the market catching up to the data rather than speculative targets that require new information to achieve. The complete convergence that XRP is experiencing right now. Number 3, market cap ranking, $1.44 billion in cumulative ETF inflows, SEC and CFTC commodity classification, American Airlines Treasury integration, Rakuten 5 million merchant deployment, Mastercard pilot program, wXRP live on Solana, RLUSD massive rollout, 4-phase quantum resistance roadmap in active phase 2 development, and Clarity Act markup approaching end of May is not a bull market story, it is an infrastructure story. The difference matters enormously for how you think about the current price level and the trajectory ahead. Bull market stories depend on sentiment, momentum, and retail participation to sustain price appreciation. Infrastructure stories depend on utility, institutional adoption, and regulatory clarity, all three of which are accelerating simultaneously for XRP right now, while the price is still consolidating between $1.42 and $1.45. The institutions are not buying XRP because they think the market is going to go up. They are buying XRP because the infrastructure they need to exist is already built, already legally cleared, already quantum resistance roadmapped, and available at a price that reflects none of its combined institutional significance. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.